As we do wait for earnings, let's bring in our first guest, Barbara Doran from BD8 Capital Partners. Barbara, I want to stick with this theme. I hear Waller talking about an unsustainably hot labor market. We get ISM services tomorrow. It's going to be a big focus on prices paid. What do you think of the commentary we're getting from the Fed, which we know is signaling higher for longer?
Yeah, well, I think it's very consistent with what they've been telling us, higher for longer. And I think the market has known it's true. And when you saw the inflation data stalling out, you saw that hot jobs number, last month. I think the market is already, and that's what we saw this sell-off after a really strong January and February. But the interesting thing to me is that the market, the S&P is still up almost 3.5%. It was up 7%. And the NASDAQ is still up around 9%, having been up 14%. So I think the market is discounting a lot. And I think the market is looking at 3 potential 25 BIP increases, March, May, and June. So the market continues. Investors continue to look through that. But obviously there's a lot of uncertainty in a wide range of outcomes. And investors are now as data dependent as the Fed. We're hanging on every inflation number to see where it might lead and what it might mean.
Okay, let's talk more about the data. Let's turn now to CNBC senior markets commentator Mike Santoli with today's market dashboard. Mike.
Yeah, John, this sort of walk down the stairs tied at the ankles with stocks and bonds has been going on for a while, and not just in this country. As a reminder, this has been a global phenomenon. Overnight, we got another hot inflation reading out of Europe. Global yields are rising. That means global bond prices have been falling, and global equity index is kind of following along with them. So you have international bonds, government bonds in this ETF over the last 14 months or so, and you see it's been a pretty tight relationship. But as with the U.S., you've seen a bit of outperformance here in the last couple of months by equities. That's the All-Country World Index, stock index, relative to what bonds have done. So this is leading to a lot of the either consternation or criticism of the stock market kind of not getting it and maybe underpricing where yields have gotten to or where they might go. I guess I would argue that if you go over a longer span, this is not necessarily always one for one. And as we get to the point where the yield move perhaps seems pretty mature, and maybe it's not going to be as open-ended as it was last year when the Fed went from virtually 0 to almost 5% in short-term yields, that stocks are trying to make their peace with it in the context of a recovering economy in both Europe, China, and, of course, the U.S. being a little better than expected. So you got to be on alert that maybe you have more shocks to come from bond weakness. But so far, it seems as if the stock market is attempting to put some distance between it and what debt is saying right now.
Interesting. I do want to note that Marvell's numbers have crossed. We're going to go through those and make sure we got them straight before we bring them to you. The stock did take kind of a knee-jerk move, lower, higher again, and then lower again. So working that out. Mike Santoli, so how should investors think about the yield move and what that tells them about the right time if they're looking to pick up some bonds, the right time to do that in this kind of environment?
I find it fascinating, this sort of relatively newfound excitement over bonds, of the idea of just sort of riding the yields and capturing that income, which makes all kinds of sense. It's a normalization. This is the way the world was supposed to be, where you get some safe yield, and then against it you can take some risk in stocks. What's funny to me is nobody really takes a look at the entry point a month ago, let's say, into bonds and says, well, that was really badly timed because bond prices are down 3.5% since then, because you assume it's a buy to maturity, kind of just take the income and don't worry about the mark to market and trading it. Whereas with stocks, if you bought 3% higher than it is right now in 4 weeks, it feels like a bad move. So I think that's the way to think about bonds, is just to own them and own them in whatever target allocation, as opposed to trying to time where we are in terms of the Fed cycle or anything else. The short-term yields may not stay here for long. At least the market thinks we might be getting some Fed rate cuts in the next couple of years. So it's much more a matter of be happy with what you have right now and the role they can play in a portfolio.